Welcome back, you legends. I'm Dr. Cal and I'm back from my extended hiatus. So let's get right into this video. Let's start with the daily chart of the S&P 500. And the price action for the past, let's see, March 14th, January 25th, for the past couple of months can really be summarized in a couple of charts. Let me show you exactly what I'm talking about. I published this chart on February the 21st, right here before the market opened on this exact day. And I do publish these kinds of charts, guys, these kinds of we are here charts, just to show everybody in the trading community where exactly in the stock market cycle we are trading. And I highlighted 3 yellow boxes. These 3 yellow boxes correspond with this break here, this one over here, and this one right over here. So why did I highlight these zones? I'm going to get right into that. On March 9th, I posted the second chart that's going to summarize all of this, and it highlights the exact day that these blue bullish trend lines broke to the downside. The third and most important chart is this. Every bear market rally since late 2021 has been categorized by a lower high followed by a higher high, then a trend line break and a new low. We have completed the lower high, the higher high, and the trend line break, and we're due for a new low. I published this on March 13th. By the way, guys, even though I haven't posted a video in about a month and a half, I've actually been posting every single day all of my work in the trading community. If you want to support me, if you want to keep up to date with every single thing that's been happening with the stock market, check out the link in the description below the video. You'll be able to join our legendary trading community through our Patreon page. Let's take a closer look at this chart. Here's what I'm talking about, guys. Since the top on January the 2nd, 2022, what exactly has been happening? If you notice, guys, there's been this very clear and obvious fractal pattern that I've been following for months and months now, and it's this. The market tends to make a high, followed by a higher high, and then it breaks its trend line support and makes a new low. Then it does this again, makes a lower high, a higher high, breaks its trend line support, makes a new low. Then does this again, lower high, higher high, trend line support, new low. High, higher high, trend line support broken, new low. This has been systematically happening over the past year and a quarter, since really before the market topped in January, since the NASDAQ topped in November. Right, systematically, lower high, higher high, trend line break, we make a new low. Lower high, higher high, trend line break, we make a new low. Now, this systematic pattern has been happening in very distinct phases that I'm going to explain right now. The first is a break of a minor trend line that usually takes out the 20-day moving average. Here's this one right here. This is the 20-day moving average. This dark red line, this dark red moving average is the 20-day moving average. A first break occurred here, right? But we did not close below the 20-day until this break right here. This was the first close. What happens after the first close? The market tends to weaken, then come back to retest the 20, top again, and then collapse. Right, here's another example, guys, right over here at the top in August. This was the first break below the 20-day. We came back down. We rallied back to the 20-day, had this waterfall sell-off. We had another rally to the 20-day, again rejected, massive waterfall sell-off. Here's another example, guys. It happened at every single bear market top. Here's another one, guys, right here. We broke below the 20-day, we broke below it, closed below it, the market continued to weaken, had one final attempt at the 20-day, failed, and we had that trend line break. Same exact thing happened right here, guys. Break below the 20-day, market weakened, back tested the 20-day, trend line break. Systematically, guys, systematically, take out the 20-day, back test, break. Take out the 20-day, back test, break. Take out the 20-day backtest break. Right here, take out the 20-day backtest, and break. So what happens after the break of the trend line, just like every single example here highlighted with the black circles? Well, the market ends up making a new low, a new low, a new low, and we are now in the process of making a new low. Okay, so there's been a lot more things developing recently, not just rate hikes anymore, not just inflation. What the heck has been going on? Well, let's talk briefly about the failure of SVB, Silicon Valley Bank. I'm going to try to summarize this very quickly on what happened. This is the balance sheet of SVB, right? Assets on the left, liabilities on the right. Liabilities are mainly deposits, basically, right? And this bank was unique in that it served the largest amount of startups and tiny tech companies. And what did these tech companies do? Well, let me show you this beautiful chart. This chart is for the long-term treasuries, the TLT, the long-term US treasuries. Let me tie this up together very quickly for you guys. We've been trading in this perfect ascending channel for ages now. Treasuries topped in the middle of 2020. What happened? Well, we had this China scare, China trade war scare at the end of 2018. Then TLT began to recover. What happened then? We had COVID in early 2020. TLT continued to rally as the Fed stopped raising rates here and they cut rates back to zero here. So interest rates cut down here, then back to zero with QE infinity beginning in early 2020 to save the global economy from the global shutdowns, right? So what comes with unlimited QE? Well, it tends to lead to massive inflation in first equity valuations, stock market valuations, company valuations, private equity, public equity. All of it gets massively inflated. What happens then? These tiny companies, these startups, these tiny tech companies, their valuations get massively inflated. They get a lot of investments, injections of liquidity. They take that money, they pour it into deposits in SVB, right? That's phase one. Unlimited QE, deposits increase. SVB grows its deposits. I think it quadruples its deposits in a couple of years. Now it has all of these deposits. What does it do? Deposits, remember guys, deposits in banks are liabilities. So what does SVB do with those deposits? Well, it can either loan these out, and if it cannot find enough clients to loan this capital out, what they do, all of these banks, guys, do this. They end up buying either mortgage-backed securities, treasuries, bonds, all kinds of debt vehicles. So stage one, interest rates zero. Stage two, massive deposits into SVB. Stage three is the disaster. What happens next? Well, SVB has all of these deposits. They end up buying treasuries, right? Risk-free return. That's what everybody used to call treasuries, right? Risk-free assets. Well, these beautiful risk-free assets ended up, let's see, crashing by 50% in about a year and a half, right? So SVB takes all of these deposits, they buy treasuries, unfortunately at the top, as inflation begins to roar, as the Fed begins to tighten monetary policy and raise interest rates, all of these long-term treasuries get absolutely crushed. So what happens next? Now you took the deposits of these clients, you bought treasuries, you bought this investment failed. Now, if you had to hold these investments into maturity, you would have been fine, right? You would have recovered all of your deposits. But what happens is that these companies, because these are tiny tech companies, they're growth companies, they burn a lot of cash. So what ends up happening? They end up tapping into the deposits. Now you have your assets in mortgage-backed securities, treasuries, etc. These assets get a massive haircut. Now you begin to fail meeting your depositors' needs, right? You will not be able to give back those depositors their money because you are holding long-term assets that have collapsed. You either need to hold them for 20, 30 years to get back your money, or you will need to liquidate them at a massive loss. That's what ended up happening. They ended up having to liquidate to pay the depositors. Now, as soon as that began to happen, guys, as soon as SVB announced an equity raise to shore up its balance sheet after taking that massive loss on its bond sale, everybody got a whiff of that. And when that happened, a bank run begun. Why? Well, because these are tiny companies, right? They cannot risk losing their deposits. So what ended up happening is that they ran to the bank, everybody tried to take out money, and the more and more of your clients trying to take out money, the deeper hole you're digging, right? Because you need to liquidate more and more of these failing assets. You will not be able to hold them into maturity, so you'll need to liquidate more and more, and that's how SVB failed. Now, here's the massive, massive problem with all of this. The Fed, FDIC, and the Treasury, they ended up intervening to save the depositors. What they ended up doing is that they ended up bailing out not the bank. Boom, bank went bust. Nope. They ended up bailing out the depositors that had their money in the bank that would have otherwise lost all of their money. Anything above $250,000 would have been almost completely lost, right? The Treasury, Fed, and the FDIC ended up interfering to save the deposits. What they ended up doing is that they built this fund. It's now at $25 billion. A combination of money from the Fed and the Treasury and the FDIC to pay back the depositors all of their money, including deposits above $250,000. Now, in my personal opinion, that was the right move, right? Because the depositors should not bear the blame, because the depositors had nothing to do with the failure of the bank, right? They were innocent bystanders. They should get their money back, and they're getting their money back. Now, here's the massive issue with all of this, guys. Boom. SVB collapse highlights $620 billion hole lurking in banks' balance sheets. Now, this includes huge banks like Bank of America. Bank of America has the biggest losses in bond portfolio among peers, among the big banks. That includes JPM, Morgan Stanley, etc. Now, if we take a look at Bank of America, we can clearly see a massive, massive sell-off. It even took out the October low, and that's a direct reaction to the bond portfolio of Bank of America. Again, guys, this is not just Bank of America. This is not just SVB. So many banks, in fact, the grand majority of banks, they have their assets in bonds. They have their assets in bonds, and now bonds are absolutely crushed because of the interest rate hikes by the Fed. And it is absolutely inevitable that bank after bank will fail right after SVB. This happens at every boom and bust cycle, guys. We get a boom, then we get a bust. And at the early portion of the bust, you get those extremely high risk assets like Bitcoin, crypto, etc. They blow up first. Next, you get the high flying stocks with massively inflated valuations, no real cash return. They're just burning through their cash. They need to raise money just to stay in business. These get crushed. So we have crypto, high growth names, and then what happens next? Well, this cascading effect, guys, tends to jump from high risk into lower risk, until everything crashes. So it started with crypto. Crypto basically topped in early 2021. Then you had things like ARK-K, right? The extreme hyper growth names, those topped in 2021. Then you had the NASDAQ, it topped in November. Then you had the S&P, it topped in early January of 2022. Then you had the FTX collapse. Then you had the SVB and Silvergate collapse. And it's just going to continue and continue and continue until the market bottoms, until we hit the peak of the recession, which will likely happen sometime late this year into early next year. Bill Ackman says more banks will likely fail despite Fed intervention. Now, if you're an astute market watcher, you will notice that what happened with the Fed, FDIC, and the Treasury when they interfered with the depositors in SVB, as well as a couple of other banks, is that it's the Fed signaling to the market that please do not worry, we will put a backstop, a stopgap solution to rescue the depositors. The hell with the bank, we don't care, let it go bust, but we'll rescue the depositors. Now, to me, this signals that the Fed is actually going to continue to raise rates. And that's exactly why it had to intervene, because the Fed knows that they will need to continue to raise rates. We will continue to see bank failures. And as that continues to happen, the Fed will need to intervene every single time it happens. What we're now seeing with the narrative is that it is beginning to change. The bulls are now saying, oh, wait, because SVB failed, the Fed will now have to pivot, right? That's the delusion coming again, saying, oh, okay, don't worry, this is the bottom, right? The SVB collapse is the bottom. The Fed has intervened. They will cut rates and we will be saved. That's it. October bottom is in. You will need to buy now, right? Completely wrong. Absolutely completely wrong. And here's proof, guys. I posted this March 13th. Here's exactly what happened on the day of the Lehman collapse. This was the Lehman collapse. The market ended up declining the following 2 days. Then it had this massive face-ripping dead cat bounce. We bounced. The market continued to crash from that point on. We are now in the middle of that dead cat bounce. Here it is, guys. We had this trend line support. We have now broken below the trend line support. We have this rubber band effect after the Fed intervening, right? This happened on Monday. Fed intervenes Sunday evening before the futures begin to trade. That's an obvious move to save the market, at least in the short term. The Fed intervenes. Market gets this rubber band effect, and it's now very likely to fail at this point here as it gets rejected at the 200-day moving average, as it finds significant sell side at this resistance line, as it finds significant sell side at this prior support line, now a major resistance line. And it's not as if this hasn't happened before, guys. We know how this story ends, right? Fed intervenes, we get a dead cat bounce, the market realizes the Fed will continue to raise rates, and more banks, institutions, financial institutions, hedge funds, etc., more and more will fail, and we will continue to see massive selling. Now, I want to bring up the Dow Jones because this is a critical chart to watch. Why? Well, because it led us out of the October bottom. It led the market. It was the first to take out the 200-day moving average. It bottomed with this double bottom formation. It did not make a lower low like the S&P did right here, and it had the biggest rally after that October bottom. What happened next? Well, we made this double top formation with a lower high on the second top, significant lower high on momentum on the PPO, and we formed this ascending wedge bearish topping formation. We broke right here. I shared this exact break with the trading community in the Discord group. I noted that this is an objective short entry, and another objective short entry would be at a bounce and a rejection at the bottom of this wedge support line. That's exactly what happened. I shared this on March 6th in the trade setups channel inside the trading community. Dow Jones completes the ascending wedge retest I've been waiting for. This is technically and objectively the ideal short entry for the DIA. And if you notice, guys, look at this. Perfect rejection, massive sell-off, took out this prior low. What's going to happen now? Well, we are in the midst of this dead cat bounce. It will likely try to push again tomorrow if PPI comes in cooler than expected, or if simply the market deems the PPI reading cool enough. You will see this dead cat bounce continue and probably end here tomorrow at this level on the Dow, right at 325. It will likely max out at around this level. If you take a look at the hourly chart on the S&P 500, this is a new chart setup that I've been working on for quite a while. I began sharing this with the trading community about a month ago, and we've been using this to pinpoint key pivot points, supports, resistance levels, as well as turnarounds. So how have we been using this recently? Well, it allowed us to spot this pivot right as we hit this support zone, right? Prior resistance, support. It's a key pivot zone. We hit it, then we bounced back. We got a perfect rejection off the fast moving average. We made a new low, we recaptured that zone, and then we rallied back to this major resistance zone. Here it is, guys. The SPY is approaching a major pivot zone at 387. It bounced exactly at that zone, found resistance near this prior resistance line. This will likely continue to act as resistance, as it did so again today. Look at this, rallies back to the resistance line, finds rejection, comes back down, and closes just below that line at the close of today. Now, the market is waiting. It will either do this, right, or it will do this, right? It's waiting for PPI. If PPI is, again, cool, you will see continuation of this dead cat bounce. And the next likely point of failure is going to be the slow moving average, this purple line, as I saw a rejection here, as well as this key pivot point, this prior support now will act as major resistance at 396. What's at 396 again, guys, is also this beautiful trend line. So we have a convergence of the trend line here and the fast moving average, and the slow moving average and this pivot point. So again, if PPI is bullish, the market will rally here and then it will fail and continue to sell off. If PPI is bearish, we will again open with a gap down and continue to sell off. So in either case, the market will sell off very likely either tomorrow or the day after, and we will very likely take this prior low and begin to form a much more obvious divergence for the market to go back down, fill this gap right here. This is a key gap at $374 on the daily chart. I've highlighted it. You will see it here, 374. So again, something that looks like this. Boom, another break. We go back down to this pivot zone, fill the gap. Another attempted rally, failure at that zone. And then we move on to make new lows and revisit these October lows. So that's what it looks like right now. What we do know for sure is that the false break top that I've been talking about for a month and a half now, I started to talk about it as the market was rallying here. This false break top is now confirmed. Why? Well, we had the break of this support line, this trend line, and then we had the break of the bear market resistance line. So we have a double break, and then we had a break of the 200-day. So what is a false break top, and what does it mean, and why does it even matter? Well, guys, a false break is when the market rallies, breaks a key critical resistance zone, then it fails, it tops here, then it comes back down, and it takes out the level of resistance that it previously broke. It comes back down, trades below it, and it breaks major support levels. Why does it matter? Well, because false break tops, guys, are exceptionally bearish. And the longer the market trades below these critical levels, the more market participants realize that this is indeed a false break top, the more obvious this false break becomes, and the more negative the narrative becomes, right? We had the perfect storm here, guys. Again, lower high, higher high, trend line break, new low, lower high, higher high, trend line break, new low, lower high, higher high, false break top. We took out this massive resistance line. We took out the 200-day moving average, all major resistance lines. Then we failed. We failed to rally from that point on. We formed a bull flag, a false bull flag that ended up breaking right here on February the 16th. That break was confirmed the day after because we closed below the 20-day moving average. Then we began that cascade that I talked about. Break below the 20, come back down, retest the 20, fail again, come back down, take major levels of support, including this blue trend line and the dark red bear market trend line, as well as the 200-day moving average, rejected twice here, highlighted in yellow. And we are now again in the midst of this dead cat bounce that will inevitably fail and take out the December low. Why do I say that? Why am I saying that the market will take out the December low? Well, because I have very good technical signals from breadth. Let's take a look at breadth, guys. This is the 50-day breadth in the S&P 500. It measures how many stocks in the S&P 500 are trading above their 50-day moving average. It's a percentage, and we're now at 21%. We took out the December low in the 50-day breadth. Worse yet, the 200-day breadth, the longer running breadth indicator, has taken out the December low. Worse yet, the Dow Jones that led the market up has taken out the December low. Want more proof? Well, let's take a look at the 10-year yield. Notice this, guys. The 10-year yield had this massive break on the SVB blow up. It ended up with this massive dump in yields. And what usually happens, guys, when yields move down, example here, the market tends to move up, yields down, market moves up. This is true when there's financial stability. Why does it happen? Well, when yields go down, stock market valuations go up. That's basically what happens. PE ratios expand when bond yields decline. Something different happened recently. And why is that? Well, because the decline in yields this time around was driven by financial instability, not stability, financial instability. What ended up happening is that money came running out of the stock market, out of risk assets, and into bonds, pushing yields down, right? When bond prices go up, yields come down. So we're seeing a flight to safety. What confirms this to us is gold. Look at gold, guys. Doubled bottom. Beautiful, beautiful double bottom. We have now achieved our first price target. Second price target is these prior highs at 181. And after that, I think gold will move on to make all-time new highs. Absolutely all-time new highs, especially when the Fed pauses and then begins cutting rates. I think gold would absolutely explode and the dollar will completely collapse. So we have the yield contradicting this move up. Again, a sign that it's a counter trend, fake out, dead cat bounce. We have the example from the Lehman Brothers collapse in 2008. And more so than that, guys, we are still trading, even on the smaller time frames, we're still trading well below all of our moving averages. Notice how when the market was rallying, all of these moving averages held. We are now seeing the market reject at every one of these moving averages. By the way, guys, again, if you want a live link to this exact chart updated every single day with the key pivot points, resistance lines, and support lines, as well as my proprietary settings for the stochastic, as well as these moving averages, check out the link in the description below to join our trading community. This is a new feature that I've been working on for a while, and it's been working out very, very nicely for us, allowing us to identify key points in the smaller time frames. And again, these are examples of how exactly we use them. As we hit that pivot point, the market rallied again, and as it rallied again, it failed at that resistance zone. So these zones have been absolutely on the money. Let's take a look at the VIX. The VIX had this beautiful symmetrical triangle breakout pattern. We had this false break below this support line. Then we had this decisive, impulsive move that broke out above this resistance line, above this support line, and it happened on the day of the trend line break. So it is absolutely significant. It's very important when something like this happens, guys. When you see a confluence of several technical indicators, that's when we need to pay very close attention to what's happening in the stock market. So what's going to happen with the VIX? Well, the VIX is finding resistance at my resistance levels. Again, look at these levels. They've been working perfectly so far since the beginning of the bear market. What tends to happen, guys, is that the VIX tends to visit these levels, come back down, cool down for a bit, go back up, form a lower high. The S&P makes a lower low, and it forms a double bottom formation, from which the market tends to rally. This has happened systematically throughout this bear market. I will show you exactly how this has happened at every bear market top. Notice this example right here. At the March top, the market began to sell off. We went all the way down. The VIX topped right here at this level. It came back down, formed a slightly lower high. Boom, we made a lower low on the S&P. We had this counter trend rally. Then it went on to make an even lower high, confirming this double bottom. We had another rally. Then the VIX went down significantly, broke out again, made another lower high, confirming this bottom. And that was the June bottom that resulted in that prolonged bear market rally. Exact same setup happened here, guys. Formed a lower high as the S&P was making a lower low right here. Confirmed the bottom, market rallied. So we're in the middle of this process right now. VIX tagging this resistance line, cooling down, will inevitably come back up. If it makes a new high, then that will invalidate any bottom the S&P makes. But if it makes a lower high, it will validate the lower high that the S&P makes, and it sets up for a nice counter trend rally. Then then very likely the VIX will move back up, form another lower high, and the S&P will likely make another lower low, forming another significant divergence and another significant counter trend rally. Now, something absolutely beautiful that I've noticed on the charts is this. Look at this, guys. Look at how steep this rally is. Now, notice how this rally right here is significantly less steep. Now, notice how this entire move right here is significantly less so. And very likely, the S&P will do something like this, right? Boom, boom. It will rally and sell off between key pivot zones, and then it will try to find some support, begin another weak counter trend rally with an even shallower angle, right? An even shallower angle, and then fail yet again. And at that point, guys, the S&P will very likely break all the way down, taking out this descending channel. Why do I say this, guys? Because it happened in every bear market since 2000. Here's an example: steep rally, boom, now a shallower rally, then an even shallower rally, very weak, very anemic, and then the S&P 500 ends up breaking below this channel. Notice this channel, guys, almost perfect channel, false break top, exactly like what we're seeing now. False break top, comes back down, anemic rally, takes out the channel. Let me show you what happened in 2000 because it looks identical, guys. It's kind of funny. Look at this: false break top, anemic rally, massive sell-off, takes out this channel. What is the channel? This is the channel. Here's the channel, held at support, broken and broken. And the market ended up bottoming about a year and a half later. After this false break top, the market ended up bottoming. Let's see, 360 days, almost exactly a year later, the bear market ended and it began to rally in earnest, taking out this prior resistance line with the 50 crossing above the 200 and a real bull market beginning to develop. Now, I do have some bad news for you guys, especially the long-term investors here. The S&P 500, the market in general, will likely not really begin a bull market until not only a year from now. I think it will take even longer than that. I think we will begin to really rally in earnest about March of next year, simply because the amount of insane stimulus and the absolutely enormous bubble that resulted from all of this. It will take quite a while to unwind this bubble, and unfortunately that's why we will probably see a lot of this choppy trading for at least another year, with significant weakness coming in at the back half of this year as more of those interest rate hikes begin to trickle down into significantly weaker earnings. Let's take a look at the fear and greed index. We are at 26 fear. We were just at extreme fear 19 reading just a few days ago. This was the prior close. And we will likely see an extreme fear reading of zero. Yeah, we've seen extreme fear readings of zero in this bear market leg down into October. We'll likely see that again as the S&P 500 tries to hammer out a bottom just below the October bottom, probably several months out from now, as the Fed very likely will continue to raise rates into the next meeting at 25 basis points. Everything they've done so far indicates that we will continue to raise rates. No pause yet until maybe a couple more interest rate hikes, unless something major breaks. And if that happens, well, bad news, guys. Bad news. Here's why. Let me show you. Up top, guys, is the yield curve, the 10 divided by the 2. Below this beautiful horizontal red line is yield curve inversion. I've highlighted in these vertical red lines every single time the bond market exited inversion and began to steepen. What happened? Well, the market topped just a couple months later, and then we had the crash of 2008. And what happened here? Well, the market topped just a couple months earlier, and then we had significant selling ensue. Well, bad news, guys, is we've already been in this prolonged, protracted correction since January of 2022. And unfortunately, guys, the bad news is that this correction has just been a correction. This hasn't been really the recession bear market. This has just been a correction in response to higher interest rates. And so when the yield curve begins to steepen and exit inversion, that's when most of the downside resides. Let me show you exactly what happened here, guys. Look at this. The S&P 500 bottomed here after the yield curve began to steepen. Then we had this pullback to the 9-month moving average. This was the perfect shorting opportunity because it corresponded with this final leg in the market. Then we had that massive sell-off. If we take a look at the 2000 bear market, the exit of the inversion, the end of the inversion, really came just after the market topped. We had this massive selling. If we take a look at today, we haven't even began to exit inversion quite yet. We're probably a few months away from the bond market exiting inversion and beginning to steepen. When that happens, guys, gold, long-term treasuries, these will be the winning assets for those long-term holders out there. Let's take a look at the economic events tomorrow. We'll have PPI at 8:30 a.m. Eastern Time, retail sales 8:30 a.m. Eastern Time. Again, if PPI and sales come below expectations, expect this Lehman-style dead cat bounce to continue at least for a day. Then very likely top 396 and the Dow Jones top at, let's see, 325 to 326 as well, and continue selling down from there all the way back down to the October low or even lower than that. That's all I have for you today, guys. Thanks so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.